This LOS is describe regular cash dividends, extra dividends, liquidating dividends, stock splits, and reverse stock splits, including their expected effect on shareholders' wealth and a company's financial ratios. Before we jump into this LOS, we'll just do a bit of an introduction. This reading covers the features and characteristics of dividends and share repurchases, the two ways a company can distribute cash to its shareholders. A dividend is a distribution paid to shareholders based on the number of shares owned. Taken together, cash dividends and the value of shares repurchased in any given year constitute a company's payout for the year. A company's payout policy is the set of principles guiding payouts. Dividends and share repurchases concern analysts because as distributions to shareholders, they affect investment returns and financial ratios. When share price volatility is high, investors sometimes forget the importance of dividends as a source of return. From its inception at the year-end 1969 to the end of 2008, the gross total return on the MSCI Europe-Asia Far East Index was 9.7% compounded annually with dividends reinvested, as compared with 6.7% on the basis of price alone. The contribution of dividends to the total return for large cap U.S. stocks over the 1926 to 2008 period is even more formidable. From the inception of the Ibbotson U.S. large cap data at the beginning of 1926, the total compound annual return with dividends reinvested from the beginning of 1926 to the end of 2008 was 9.6%, as compared with 5.3% on the basis of price alone. Dividends also may provide important information about future company performance and investment returns. Analysts should strive to become familiar with all investment-relevant aspects of dividends and share repurchases. Dividends, forms of dividends. So we're going to start by looking first at regular cash dividends. Dividends can take the form of regular or irregular cash payments, stock dividends, or stock splits. Only cash dividends are payments to shareholders. That's important, and that's why it's been put in bold. Stock dividends and splits merely carve equity into smaller pieces and do not create wealth for shareholders. Reverse stock splits usually occur after a stock has dropped to a very low price and do not affect shareholder wealth. They represent cosmetic repackaging of shareholder equity. Regular cash dividends, unlike irregular cash dividends, stock splits, and stock dividends, represent a commitment to pay cash to stockholders on a quarterly, semi-annual, or annual basis. So at the bottom there, I've written assets equals liabilities plus equity. So think, if cash is paid out, that's a decrease to assets and it's a decrease to equity. That will impact all the relevant ratios that involve assets and equity. If it is a stock dividend, you're going to debit retained earnings and credit equity common shares. There's no change to the E, but decrease retained earnings and increase contributed capital. So let's just do a little practice question to check our understanding. The payment of a 10% stock dividend by a company will result in an increase in that company's A, current ratio, B, financial leverage, or C, contributed capital. Okay, the correct answer is C. A stock dividend is accounted for as a transfer of retained earnings to contributed capital. So as I just said, you're going to debit retained earnings and you're going to credit contributed capital for a common stock dividend. The current ratio is current assets minus divided by current liabilities. Nothing's happening to current assets or current liabilities. In financial leverage, assets over equity, nothing's happening to the equity. It's just a transfer from retained earnings to contributed capital. Another quick practice question. If a company's common shares trade at relatively low prices, the company would be most likely to consider the use of A, stock split, B, stock dividend, or C, reverse stock split. Okay, a pretty easy question. C is correct. A reverse stock split would increase the price per share of the stock to a higher, more marketable range that could possibly increase the number of investors who would consider buying the stock. Another instance is when an exchange has a minimum trading price. Let's say the minimum trading price is $1 and the stock is getting close to that minimum trading price. Well, let's say it was a 1-for-5 reverse stock split, and let's say the stock was trading at $1. Let's say before you had 10 shares, okay? You'd have 10 shares at $10 each. Reverse stock split, 1-for-5, you would now have 2 shares, and they'd be trading at $5 each. It's still worth $10, but you have only 2 shares, not 10 shares anymore. And that's how a reverse stock split works, okay? One last practice question to check our understanding. In a recent presentation, Doug Pierce made 2 statements about dividends. Statement 1 is a stock dividend will increase share price, all other things being equal. Statement 2 is one practical concern with a stock split is that it will reduce the company's price to earnings ratio. Are Pierce's 2 statements about the effects of the stock dividend and stock split correct? A, no for both statements. B, yes for statement 1 and no for statement 2. And C, no for statement 1 and yes for statement 2. Okay, good little question. A is correct. Both statements are incorrect. A stock dividend will decrease the price per share, all other things being equal. So remember, if I just do my little T accounts, I've got retained earnings here and I've got contributed capital here. A stock dividend, there's no change to the E at all. I'm going to debit retained earnings and contributed capital, no change to E. But I've increased the number of shares, so the price has to have gone down, okay? Now a stock split will reduce the price and earnings per share proportionately, leaving the price to earnings ratio the same. So that's the little tricky one that you might have had to think about, but once you've seen it, memorize it. The rule is that with a stock split, it will reduce the price, but it'll reduce the earnings per share proportionately, leaving the PE ratio the same. The PE ratio remains the same. P went down, earnings per share went down proportionately, no change to the PE. And that's the last slide for this LOS. Thank you.